Welcome back to the deep dive. Get ready, because today we're plunging into a really vital topic, market integrity. We're going to be unpacking the market abuse regulation. You'll probably hear it called MAR quite a bit. And for this deep dive, we're drawing heavily on insights from a great article by FinCrime Intelligence. Our mission today, really cut through the jargon. We want you to understand what MA actually is, why it's so critical for, keeping financial markets honest, building investor confidence, and also how it's actually enforced and how it's evolving. We've gone through the source to pull out the key takeaways for you.
That's right. Think of this as getting the essential story of MR. Without getting totally bogged down in the dense legal text, it's about understanding its core purpose, why it exists, and the main ways it works to make sure everyone's playing fairly.
Okay, so let's start right there. The basics. What is MAR, fundamentally?
Yeah.
And why did the EU feel this comprehensive regulation was, well, necessary?
Well, the source defines it pretty clearly. It's an EU regulation, and its specific goal is to prevent market abuse, things like insider dealing across all EU financial markets.
And the why. That seems crucial.
Absolutely. At its heart, MAR is about safeguarding the integrity, the trustworthiness, and the transparency of these markets. I mean, think about it. If you, as an investor, don't trust the system,
Yeah.
if you think it's rigged or somehow unfair,
You wouldn't invest?
exactly, you won't put your money in. And that lack of confidence, it hurts everyone. Individuals saving, businesses needing capital, the whole economy, really.
The source actually lays out some very specific objectives for MA, doesn't it? Things they were explicitly trying to achieve.
It does. They wanted to prevent, detect, and punish market abuse effectively. That's key. Plus, creating a single EU rulebook that brings much-needed consistency across different member states.
Right.
And enhancing investor protection specifically from manipulative tactics was a big one. Also boosting the detection and deterrence of insider dealing and stopping people from unlawfully sharing sensitive information.
And I think you mentioned a level playing field.
Yes, promoting a level playing field across all the different places people trade, the various venues, and across different types of financial instruments. And, the source points out it doesn't stand alone. It works hand in glove with other big regulations like MiFID, SESN, and MiFOR.
Well.
Yeah, it creates this sort of cohesive supervisory net. Ultimately, this whole structure, it's built to create market trust for you.
Speaking of that level playing field, the scope of MAR, I was quite struck by how broad it is, according to the source.
Yeah.
It's definitely not just the big stock exchanges we picture.
No, it's deliberately very wide-ranging. It has to be. MAR covers financial instruments traded, yes, on regulated markets, but also on MTFs, that's multilateral trading facilities, and OTFs, organized trading facilities.
So smaller or alternative venues too.
Precisely. That captures a much bigger slice of the trading pie. And it goes beyond typical stocks and bonds. It extends to spot commodity contracts, emission allowances, even critical benchmarks like interest rate indices.
Which we know can be manipulated with huge consequences.
Absolutely, we've seen that happen. And it covers over-the-counter, OTC, trades those direct deals if they're linked back to instruments trading on the listed venues. And crucially, it applies to the companies issuing the instruments, the issuers. Doesn't matter if they're based inside or outside the EU.
As long as their shares or bonds trade on an EU market.
Exactly. If their instruments trade on an EU venue, MAR applies.
But what really jumped out at me from the source, it's not just firms or issuers who are bound by this. It specifically mentions analysts, journalists, and this seems key, any person in possession of inside information. That net feels incredibly wide.
It is, and intentionally so. The regulators understand that sensitive price-moving information, it can leak from anywhere. It can be misused by anyone, not just finance professionals.
Right.
So if you happen to come across material non-public information, something that could genuinely affect a market price, you're caught by MAR. You can't misuse it. You can't pass it on unlawfully. That broad reach is absolutely essential because abuse can start from so many different places.
Okay, let's unpack that a bit more then. What specific actions, what behaviors does MAR actually label as market abuse? What are the things it's trying to stamp out?
The source breaks it down into three main categories because these are the things that really undermine market fairness. First, you've got insider dealing. That's probably the most famous one.
Trading on secret info.
Essentially, yes. Trading financial instruments when you have confidential information that the public doesn't have and which would likely influence an investment decision.
Makes sense. What's the second?
The second is the unlawful disclosure of inside information. This is about passing that sensitive data on to someone else. Even if you don't trade on it yourself, just sharing it improperly is forbidden because you're enabling potential abuse.
Got it. And the third?
The third main type is market manipulation. This covers a whole range of practices, but the core idea is deliberately doing things that create a false or misleading impression about, say, the supply or the demand or the price of a financial instrument. Tricking the market, basically.
The source gave some really interesting examples of what manipulation can look like. Could you walk us through a couple?
Sure. And it's not always super complex, high-tech stuff. It can be as straightforward as spreading false or misleading news or rumors to try and artificially inflate or depress a stock price. Then you have those classic schemes like pump and dump.
Ah, yes, the oldest trick in the book almost. Still happens, though.
It really does. Someone buys shares, hypes them up, often online now, with false claims to drive the price up. Then they sell out, dump their shares at the inflated price, leaving everyone else holding the bag when the price collapses.
Nasty. What else?
Well, the source mentions more technical examples too. Things like wash trades or mashed orders. These are essentially fake trades. Parties agree in advance to buy and sell between themselves, creating the illusion of activity or influencing the price, but with no real change in who owns the asset.
Creating false volume.
Exactly. Or marking the close, deliberately trading right at the end of the day to try and manipulate the official closing price. And then there's stuff like, quote, stuffing. That's flooding the market systems with huge numbers of orders that get canceled almost immediately.
What's the point of that?
It's not about executing trades. It's about disrupting the market, maybe slowing competitors down or trying to figure out hidden orders. Manipulative intent.
Okay, that's quite a list. And the source made a really crucial point here. It said these things are forbidden whether they're done intentionally or through negligence. That seems significant. How can just being negligent count as market abuse?
That really underscores the responsibility MAR places on firms and individuals, too. It means if your company, for example, lacks proper systems or doesn't have good controls or maybe hasn't trained its staff properly, and that leads to market abuse happening. Maybe an employee accidentally leaks inside info because they didn't understand the rules, or the firm's trading algorithm wasn't designed to prevent manipulative orders. Then the firm, or potentially the individual, can still be held responsible.
Wow.
Yeah. So the regulation isn't just about catching people acting maliciously, it's also about demanding robust safeguards to prevent abuse, even if it happens by mistake.
Okay, so that puts a huge onus on firms to be really proactive, doesn't it?
Yeah.
What are the core things companies and people in the market actually have to do to comply? The source lists several obligations.
It does. There are some key requirements. For issuers, the companies whose shares or bonds are traded, maintaining accurate insider lists is fundamental.
Keeping track of who knows what.
Exactly. Who has access to inside information at any given time? And they have a crucial duty to disclose inside information publicly as soon as possible. Now, the source does note that delaying disclosure can sometimes be justified under strict conditions, but it needs solid reasons and careful documentation. Transparency is the default. There's also the requirement for managers' transactions reporting. You often hear this called Article 19 reporting. PDMRs, persons discharging managerial responsibilities. Basically, top execs and directors, they have to report their own personal trades in their company's securities.
So everyone can see what the insiders are doing with their own money.
Precisely. It adds another layer of transparency.
And what about the financial firms themselves? The brokers, the exchanges? They have a big role, right?
A critical role. Firms operating trading venues and investment firms that execute orders for clients, they must have systems to detect and report suspicious activity. These are called suspicious transaction and order reports, or STORs. They have to file these with the regulators.
So they're like the first line of defense.
Exactly. They're on the front line, expected to spot potential loss in the trading flows they handle. And underpinning all of this, across the board, is the need for proper training and awareness. Firms have to make sure their employees understand the rules, their obligations, and how to spot red flags.
So with all these rules, all these obligations, what happens if someone messes up? What are the consequences?
Well, the source is clear that the regulators have teeth. They can impose significant administrative sanctions. We're not talking small fines here. They can be very substantial financial penalties.
Right.
They can also include banning individuals or even entire firms from participating in the market. And then there's the reputational damage, which can be incredibly costly and long-lasting. It definitely shows that regulators are serious about enforcing compliance.
Okay, but having rules is one thing. Enforcement relies on actually catching the abuse when it happens. How is this stuff actually detected?
Yes, detection is absolutely key, and it relies heavily on technology and pretty sophisticated monitoring these days. Think real-time trade surveillance systems. These are complex algorithms scanning millions, billions of trades and orders,
Wow.
looking for unusual patterns, anomalies, things that might signal insider dealing or manipulation tactics we discussed earlier.
And you mentioned manipulation isn't always obvious if you just look at one stock or one market.
Exactly right, which is why cross-asset and cross-venue monitoring is increasingly vital. Abusive strategies often try to hide by spreading activity across different related markets or different types of instruments. Good surveillance needs to connect those dots.
I see.
The source also mentions monitoring voice and electronic communications, things like work emails, internal chat systems, recorded phone lines. The idea is to potentially link suspicious trading activity back to, say, a leak of inside information or evidence of people colluding.
That sounds quite invasive, but necessary, I suppose?
It's a balance, but yes, it's seen as necessary for effective investigation. And when these systems flag something suspicious, there needs to be a clear process. The source calls it case management and escalation workflows. Teams investigate the alerts properly, decide if it warrants filing a STOR with the regulator. And regular internal audit reviews are also important, checking that the surveillance systems, the policies, the procedures, that they're all actually working as intended.
The source really seemed to stress how critical technology is here, didn't it? Especially with how fast trading is now. Algorithms and high-frequency trading.
Absolutely. Detecting complex, high-speed manipulation strategies used by algorithmic traders, for instance. It requires equally sophisticated AI-powered surveillance tools. It's an ongoing tech arms race, in a way.
It seems like MR compliance isn't just this isolated silo, though. The source connects it into the wider picture of financial crime. How do these pieces fit together?
Yeah, that's a really important point. There's significant overlap. For example, insider trading. It often doesn't just happen out of the blue. It might be linked to other crimes like fraud or bribery or corruption situations where someone gains improper access to confidential information
Okay, I see the link.
and market manipulation. Sometimes it's not just about rigging prices for a quick profit. It can actually be used as a technique for things like money laundering.
How so?
By creating complex or confusing trading patterns, you might try to disguise the origins of illicit funds, or it could be used for tax evasion purposes. You also see connections in the reporting. MR mandates stores for suspicious market stuff, while anti-money laundering rules require SARs, suspicious activity reports. Sometimes the same activity might trigger both types of reports, or information from one can inform the other.
So collaboration between the different compliance teams within a firm must be pretty crucial then.
Hugely important. The source really highlights this. Integrating the market surveillance team, the AML team, the legal team, it gives everyone a much better, more holistic view of potential risks and strengthens their ability to investigate and build cases. Financial crime rarely respects neat regulatory boxes, so that integrated approach is definitely becoming best practice.
Okay, looking forward now. The financial world never stands still, does it?
Yeah.
There are always new developments, new challenges. What did the source suggest about future trends? How is MAR evolving?
It's definitely a dynamic area. One major focus mentioned is figuring out how to apply MAR-like principles to the world of crypto assets and decentralized finance, or DeFi.
Ah, the Wild West, some call it.
Well, perhaps.
Huh.
But as these markets grow and become more mainstream, the potential for manipulation, for insider dealing, it obviously increases, especially for crypto assets that might function very similarly to traditional securities. Regulators are grappling with that.
That feels like a huge task.
Yeah.
What else?
Another interesting trend the source flagged is tighter scrutiny around ESG disclosures, environmental, social, governance factors.
Right. ESG is everywhere now.
It is.
Mm.
And the concern is about greenwashing companies making misleading claims about their ESG credentials. If that misleading information is used to manipulate the company's stock price, that could potentially become a new form of market abuse under MA's principles.
Interesting. A new frontier for manipulation.
Potentially. There's also a continued push for better coordination across different countries, different jurisdictions. Post-Brexit, that's obviously key between the UK and the EU, but it's a global issue because markets are so interconnected. Sharing information, coordinating enforcement.
Makes sense.
And finally, circling back to detection, the source anticipates an even greater reliance on AI-based surveillance tools, using artificial intelligence and machine learning to spot ever more subtle, complex, or novel manipulation patterns that older rule-based systems might miss entirely.
So the takeaway for firms seems to be stay alert, stay agile.
Absolutely. They need to constantly review their compliance frameworks, invest in technology, and be prepared for these evolving risks and regulatory expectations.
Well, that was a really thorough journey through the market abuse regulation. We've looked at its core purpose, who and what it covers, the specific actions it prohibits, the obligations for firms and individuals, how abuse is detected, its links to broader financial crime, and even a glimpse into the future. It's clear MAR is a real cornerstone for maintaining trust in e-financial markets.
It truly is. And as we've discussed, it's not static. It's constantly adapting to new market realities, new technologies. But its fundamental goal remains the same: protecting you, the investor, and ensuring the markets you rely on operate fairly and transparently.
Thank you for joining us on this deep dive into MAR today. And maybe here's a final thought for you to mull over until our next deep dive. Given how incredibly sophisticated financial markets are becoming, and how the technology used for trading, for manipulation, and for detection is also racing ahead, can regulators and firms ever truly keep completely ahead of market abuse? Or will new, unforeseen forms always be emerging, staying one step ahead? Something for you to think about.